Joint ventures. It is very possible that sometimes businesses will decide to work together on a particular project in a similar way to the way in which different people work together in a partnership. However, this is a temporary situation. So it's not going to be continuous or ongoing necessarily, although it might be that a certain set of businesses decide to form joint ventures on a number of occasions. But each joint venture situation would be for a particular job or activity or something, and it would be for a relatively short period of time. So it's kind of like a temporary partnership between different businesses. The reason that they might want to do this is in order to be able to share their knowledge, their resources, their contacts, etc. You can also sometimes find that they are contracted by a client and the client recommends or requires that a joint venture be used because maybe the client wants certain resources that both of them have that neither of them would be able to provide on their own. As with a partnership, the profit sharing ratio must be agreed beforehand, and this is usually the case. Once the joint venture has then been in operation, afterwards it would be worked out and the relevant profits would be allocated to each party. Let's have a look at how you would record joint venture transactions, often referred to as JV, for joint venture. Firstly, what will happen is in each business, they will record the expenses and incomes as they are earned or spent as normal. Obviously, they would credit bank and debit the relevant expense accounts, or credit bank and debit debit bank and credit the relevant income accounts. What will happen then is each individual business will create a joint venture account. So, for example, if these are the records of business A, they would then write here joint venture with B, and they would have an account that they're going to track all the joint venture costs and incomes. So the part of the expenses that relate to the joint venture will be written off or transferred to this joint venture account, as will the incomes. Once the joint venture has concluded, the profits or losses need to be calculated and allocated between the different parties. All the parties would need to share their information about their respective expenses and incomes. So once they've then been able to give this information to each other, a special memorandum account can be created. Memorandum simply means a note. This account is separate from each business as it's not part of the double entry system. Each business would already have recorded their share of or what they have spent as expenses and what they've earned as income. Whether or not it's actually their share, the share will then be calculated in a note or memorandum account. So we need to keep in mind that the memorandum account for this total joint venture showing all the expenses and incomes and where we calculate the profits or losses is not part of each business's actual normal accounting records. We'll use this then to calculate the profit and share it between the two partners. And this is what a memorandum account might look like. Basically, what will happen is the total expenses would be put in here. So these would be the expenses of both A and B combined based on the information that A and B would have been given each other, as well as the total income earned by both A and B. What would then happen is this account would get closed off, similarly to the way in which an appropriation account is created for partners and a profit share then calculated and distributed. In the same way, your missing figure over here would be your profit for the venture, and this would then be distributed between both A and B in the ratio that has been agreed previously. This would then be transferred to each person's or each business's joint venture account. It would be persons if they were sole traders. So in our account, if we are business A, this would say joint venture with B, and we would then show here what the share of the venture profit is, which would then be transferred to the statement of income. Now, interestingly, this account has already got the income that we've received here and all the expenses. And basically what needs to happen then is a payment needs to be made between A and B, either that we need to pay A or that A needs to pay us to close this account off. And so that will be shown at the end as a bank figure. Obviously, if we received more income than what we should have, and we didn't pay very many expenses, it would mean that we would need to then pay an amount to B. On the other hand, if we incurred a lot of expenses and not as much income for the profit share that we should have got, it means that we would then need to receive an amount from B in order to close off this account. And that is how you would then end up both benefiting with the correct share of the venture profit. So this amount here is what would go into the statement of income, even though the actual incomes and expenses paid or received were not relevant. They would be balanced out by these figures, which represent the transaction with the other party in order to close it all off.